You ever get that feeling of economic whiplash? You go to the hardware store and a simple copper wire costs a fortune. But then you drive past the gas station and fuel is surprisingly cheap. It feels like the entire world's pricing system has some kind of massive glitch. Well, today, we're going to decode that exact puzzle.
And this is really the heart of it all. It's a completely upside-down world where the cost of basic stuff just doesn't make any sense. One minute, you've got raw metals hitting historic highs, and the next, the very energy we need to process them is at rock bottom. And this isn't just a local thing. It's happening right now on a global scale.
So what on earth is going on? Is this some huge miscalculation by the markets? In this explainer, we're digging into what places like Fitch Solutions, Deutsche Bank, and the World Bank are saying to untangle this, well, multi-trillion-dollar mystery and figure out why the economy just feels so broken.
Okay, let's jump right in with our first big clue. And it's hiding in a really weird place, the explosive market for basic industrial metals. Seriously, this is where the story starts to get wild.
So check out this paradox. For decades, the rule was simple. If China's massive property market slowed down, metal prices would just crater. And right now, China's construction engine is absolutely stalling out. But against all logic, metal prices are soaring. This basically breaks all the old economic rules we thought we knew.
Some analysts are calling this a structural repricing. And that's a fancy way of saying this isn't your normal up and down market cycle. It means the fundamental cost to get materials out of the ground and into our hands has permanently jumped up. The entire price floor has been raised, and it's probably not coming back down.
And just look at these numbers. These forecasts from major institutions almost look like typos. Fitch Solutions thinks copper will hit nearly $12,000 a ton by 2026. Deutsche Bank is even more bullish, calling for $13,000. We're talking about massive, massive valuations for the literal skeleton of our entire infrastructure. So what's behind this? Well, it turns out the demand from the new economy is completely overpowering the slowdown in the old economy. Think about it. A single AI data center needs a staggering amount of copper. The green energy transition, EVs, AI, they're all eating up raw materials way faster than old-school construction is slowing down.
All right, on to our next clue, which honestly makes this whole thing even stranger. You'd think with all this new economy stuff consuming so many metals, fossil fuel prices would be going through the roof too, right? Well, the data shows the complete opposite is happening.
We are staring down the barrel of a potential record oil surplus. Reports from ING and the World Bank are all pointing to an excess of around 4 million barrels of oil per day by 2026. That is a literal ocean of crude oil with nowhere to go, and it's pushing prices down. This isn't a blip, it's a systemic surplus.
But wait, shouldn't cheap oil make the green transition easier and cheaper? You'd think so, but not really. This is what some analysts are calling the challenging transition. See, cheap fuel doesn't fix the physical bottlenecks. Building a huge solar farm without having the grid to carry that power is, and I love this analogy, like trying to drain a swimming pool with a cocktail straw. All that energy is just stranded.
And here's the traffic jam in more detail. First, you've got gridlock. We just don't have enough of that expensive high-voltage copper wire to move all the new green energy around. Second, you have trade barriers. Tariffs are making things like solar panels way more expensive than they should be. And finally, the big bet alternatives, like hydrogen and carbon capture, they're just not scaling up fast enough. We are stuck in a massive logistical bottleneck.
Now, this same exact theme, tons of supply crashing into these structural problems, is also playing out in our food system. And this is the part that you probably feel in your wallet every single week.
So get this, we're looking at an 8-year streak of rising global wheat production. 2026 is on track to set another new record, and corn is having some incredible years too. Basic Economics 101 says that with this much supply, prices should be dropping like a rock, right?
But here's the crazy part. Even with these record harvests, farmers are getting absolutely squeezed. Many are struggling just to break even. So why? What's the anchor dragging them down? It's the stubbornly high cost of their raw materials, especially fertilizer.
And this slide just illustrates the disconnect perfectly. We've already established the world is swimming in cheap natural gas, which is the main ingredient for nitrogen fertilizer. But because a tiny handful of companies controls the global fertilizer market, they have almost no incentive to pass those savings on to farmers. So you have this insane situation where farmers are selling their crops for less, but paying more for the stuff they need to grow them.
Okay, so let's pull all this together. We've got base metals in an absolute frenzy.
We've got traditional energy in a glut, and we have agriculture totally fragmented by trade issues and high costs. So if you're a central bank trying to navigate this chaos, where do you put your money? Well, it turns out every report we looked at points to one very ancient solution:
Gold. And the forecasts are just staggering. Deutsche Bank is out here predicting gold could hit $4,500 an ounce by the end of 2026. This isn't just a bull market. This is a complete redefinition of gold's role in the modern economy.
But here's the real head-scratcher. The same reports that are forecasting this insane gold rush also say that the global economy is going to remain generally robust. They are predicting a 2008-style financial meltdown. So why are central banks hoarding gold like the world is ending if the system itself isn't collapsing?
And here is the answer. The big fear for central banks today isn't another economic collapse. It's something new: weaponized uncertainty. In a world with shifting alliances and constant geopolitical tension, the rules of global trade are being rewritten almost daily. The digital banking system itself can now be used as a weapon to freeze another country's assets.
And in that kind of world, gold becomes something more than just a hedge against a recession. It's a hedge against a world where you don't know who your friends are going to be next year. It is the ultimate insurance policy because, well, you can't freeze a physical bar of gold sitting in a vault with a keystroke. It exists completely outside the digital system.
So what does any of this have to do with you? I mean, a $13,000 forecast for copper might seem really abstract, but believe me, you are feeling these exact same cross-currents in your daily life.
Every time you're trying to budget for groceries, or you see the sticker price of a new EV jump, or you're just trying to figure out why your heating bill is all over the place, you're feeling that same economic whiplash as the world's biggest banks. This bumpy, awkward transition from the old economy to the new one, it shows up right there on your credit card statement.
So, I'll leave you with a final thought to chew on. If 2026 really does solidify a world where physical stuff is more valuable than ever, how does that start to shift the global balance of power? Will the nations that are rich in resources gain real leverage over the nations that are heavy on tech? It's a real possibility that in the near future, the physical dirt beneath our feet could become a whole lot more valuable than the digital cloud above our heads.